Our next guest does remain bullish on earnings for this year and next. Ed Yardeni joins us today, Yardeni Research president. Ed, great to have you back. Good morning.
Thank you. Good morning.
You've been so constructive on sort of the long-term picture on earnings, even the indices, on productivity. Right. But it did sound at the beginning of the year like you were a little more cautious about the first half. Can you go into that a bit?
Well, we had such an amazing rally. It was really almost a melt-up at the end of last year, and the Santa Claus rally started way ahead of schedule. It started on October 27th. And as a result of that, valuations got a bit stretched, and I think there's sentiment is extremely bullish. So I think we're due for a little bit of, not a correction, but kind of a sideways action for a while. But then again, I look at the way the market's trading, and there's still a tremendous excitement about technology. And every now and then I get a little deja vu all over again about the late 1990s, when we also had irrational exuberance about technology. And NVIDIA is a great company, but it's reminding me a little bit of Cisco.
Although you did point out earlier in the week that how the forward PE has fallen from the 80s to the 20s.
For NVIDIA, it really has. I think not only are we seeing exuberance by investors, but certainly we're seeing exuberance by analysts. I mean, they dramatically increased their earnings expectations for NVIDIA. But look, it's a hot stock, and it's probably going to remain a hot stock as long as AI delivers. And I think it's going to take somewhat longer for AI to deliver as much as the market seems to expect. The other thing, Carl, is I think the market has expected too many rate cuts this year. I'm in the camp that we're not going into recession. It's the third year in a row I'm saying that. And I'm in the camp that believes that we're going to get 2 to 3 rate cuts probably in the second half of the year, not 4 to 5, which is what the market's been discounting. So I think the market needs to redigest here the fundamentals.
You know, Ed, you mentioned some of the parallels, or perhaps parallels, with this period versus late 90s. And, of course, right. Irrational exuberance, what Greenspan was 96, right? And then we just went parabolic for 3+ years. Do you know, how much similarity do you see with the current period? Obviously, the Internet and the excitement that it engendered in investors then versus AI now.
Well, I think there's a lot of similarities. I think the important thing to recognize is the Internet was a legitimate technology, and it's clearly been here to stay. And I think AI is a legitimate technology that's here to stay. But the problem is the market can get irrationally exuberant about just how much can be achieved in a very short period of time. And I am concerned about sort of a parabolic melt-up. I mean, it's nothing to be concerned about as long as I tell everybody to get out at the top.
Speaking of other things you've been concerned about in history that you've warned of recently, the bond vigilantes. I remember talking to you in recent weeks saying that they're back and they're concerns. And so far this year, it really hasn't been a problem. The Fed has been a more powerful force on the bond market. We've had some well-received auctions, including yesterday's. We'll get a 10-year later this afternoon. Do you think this issue comes to the fore again? Because, you know, they are going to have to boost issuance.
Well, we'll see. Clearly, one of the concerns is Washington is so partisan that we just can't get a deal done at all on anything. And we'll see. We're getting kind of close to the edge here of whether a deal is going to be struck or not. But I think that, you know, back in the good old days when Janet Yellen was Fed chair, I often observed that whenever she gave a speech on the economy, the stock market went up. She's very astute, and what she's come up with here for the bond vigilantes is she's cut back on the supply of bonds and notes in the auctions, and that's really what happened on November 1st. That's what really kicked the bond market to the downside in terms of yields, and that's what got the bond vigilantes calmed down. Is there were simply fewer notes and bonds and more bills.